Good morning. It's Jeffrey Christian of CPM Group. It's about 10:35 on Tuesday, the 30th of September, the end of the third quarter here in New York. I want to talk about metals, leasing, and what silver and gold leases really are and how they work. The idea that there is no such thing as the silver lease or the gold lease. I'll talk about that. And then I want to end with a little bit of a comment about the near record bullion banking profits that are being achieved and recorded this year due to the higher prices. So a lot to cover. Gold prices continue to rise to new levels. They've broken above $3,800 an ounce and actually got almost to $3,900 an ounce today. There are a lot of people who are worried about the fact that the prices have risen so far so fast. Our view is that there's a pull and a push between reality and magical thinking going on in the precious metals markets. You see the reality of enormous economic and political chaos and uncertainty and volatility. And that is what's really pushing investors around the world to buy gold and silver. We've seen it in India, we're seeing it in China, we're seeing it in North America, we're seeing it in Europe. It's a universal or a global issue that's going on, and it's predicated on the unprecedented since World War II uncertainty and risks that are abroad in the global political, economic, financial, and social context, as well as in national contexts in all of those areas. And in this kind of environment, with tremendous consumer and corporate and investor anxieties, you're seeing a lot of money going into gold and silver, which are relatively small markets compared to the quadrillions of dollars that are in stocks and bonds and cash. There's more money in cash right now than ever before, both on a volume basis and as a percentage of private wealth. And that is being reflected in higher prices. There are any number of people who have bought gold in the last 5 years, in the last 2 years, in the last 2 months, who are saying, well, maybe I should take some profits out. But given the level of real problems and real risks facing the world, people really don't want to leave and liquidate a position. Where are they going to put the money? Into that cash pool that's already at historically large levels? It doesn't necessarily make sense. Now, there is a lot of magical thinking that's going on, and there's a lot of strange things that are not true. Gold about central banks, and silver about fabrication demand and lack of materials, platinum and palladium about a rejuvenation in auto demand. And I hope to deal with those in a video on Friday. But for the sake of getting this video shorter rather than longer, I'm going to forego talking about those things right now, other than to say that magical thinking and these crazy ideas that people have and just misinformation and disinformation, and some of it is consciously misinforming potential investors. That's one of the big factors that's in here, trying to determine where we're going to go next on a short-term basis. CPM Group will be issuing new trade recommendations, if not today, tomorrow, across all metals. And while we're still very much bullish on gold and silver, we will sound a note of caution simply about a short-term dip down in prices. And the higher prices go, the higher a floor price would be for a sell-off, and the further prices could fall should that strange thing happen and world economic and political conditions get better. We don't see that happening, so we see the prices continuing to rise. Silver prices, meanwhile, have risen over $47. They were $46.27 earlier this morning as we were preparing this, about a half hour, 45 minutes ago. And again, as with gold, it's investment demand that is driving the price. We're actually seeing lower fabrication demand in a number of sectors, but I'll talk about that on Friday. And platinum prices have spiked sharply higher. They are now back to 1,600. That was sort of the threshold in which a lot of long-term investors who had bought from 2000 to 2007 started saying, well, maybe I'm not going to sell below $1,400 really was the level. We've seen this spike since June. It's continuing. CPM Group thinks that it is partly a reflection of lower South African production, and it's partly a speculative buying and inventory buying on the part of fabricators and shorter-term investors and traders. So we still are extremely cautious about it. The market, the long-term investors are looking at this price and they're saying, okay, this is where I had said I'm going to stop selling material. And this is where I said I will come back and look at the price, figure out why the price is rising. If the price is rising on what I think are short-term factors, I may resume selling in the 14 plus level. If I think that the price is rising because there are long-term fundamentals that have changed, I might not sell. I might even buy more. And that reevaluation of what's going on now is a key factor. And again, there's a lot of misinformation and disinformation and wishful thinking that is going into those deliberations. But platinum has spiked up over 1,600 for the first time since, I guess, 2014, probably 2013. And it looks overbought to us. Palladium also has been spiking up, although it has come off in the last couple of days. It's around $1,269. We think that is a little bit overbought as well, not as much as gold or as platinum, but we do think that there's scope for the price to come back off at some point. Platinum and palladium are unlikely to come off as long as gold and silver are rising due to investment demand. I want to talk about lease rates, and we've heard talk about silver. The silver lease rate is sharply higher, and people were talking about a 6% lease rate, but they weren't saying who that lease rate was to or what the maturity rate was. And those are very important factors because, as I say here in the second line, there's no such thing as the lease rate. And I'll discuss that in a moment. But first, let me say it's very important to understand the difference between real lease rates that are actually being charged and paid, and indicative or implied lease rates. There's no public data on real lease rates. So people cue off of implied lease rates. And those implied lease rates don't necessarily reflect reality. Talk a little bit about that too. So first off, lease rates vary greatly from customer to customer, even within a single trading company or bullion bank. If you have a bullion trading operation and a central bank wants to borrow gold, it's going to get a lower interest rate charged than an interbank rate. If another bullion bank says, I need to borrow some gold 1 month, 3 months, 6 months, a year, it will have a higher rate than a central bank would have, but a lower rate than, say, a mining company or a refiner or a smelter that needs to borrow gold to cover its in-process inventories, or a jeweler that is probably a privately owned company that cost of money is its credit card rate. So even within a single bank, there's no such thing as the silver lease rate or the gold lease rate, because the lease rates depend on the creditworthiness of the counterpart. Okay? There have been in the past efforts to publish lease rates, but these were implied lease rates. Somebody decided that they could take LIBOR less the contango and say this is the implied lease rate. The problem is that the contangos that they were using were implied contangos in the forward market, and the lease rates were implied too. And so you had a period of time. I'm not quite sure when it started. I think it ended around 2010, 2012, partly with the creation of the transfer of market regulations from the FSA to the FCA in the United Kingdom. But you had these published implied lease rates that didn't take into account the credit issue. You know, in reality, if you're a bullion lender, your lease rate that you're going to charge is going to be your cost of money interest rate. Maybe not LIBOR, since LIBOR doesn't really exist anymore, but some people still use implied LIBOR in calculating these things. Your cost of money less the contango, because you're going to be hedging your exposure to the metal, plus a risk premium and another premium. So the implied lease rates that left off the credit and other issues were not really reflective. And you had a period of time where these implied lease rates were being printed on Reuters, and they were negative. And we used to get calls from people say, "Hey, I see that people are negative lease rates. You can borrow gold and earn 30 basis points. I'd like to borrow gold and have someone pay me 30 basis points." And I say, there's nobody who does that. Those are bogus, unrepresented rates. And we actually talked to participants in the London market saying, this is a problem. The FSA was talked about it because at the same time you had a LIBOR scandal and you had a currency market scandal. And those scandals were because the LIBOR rates that were being set by the banking industry in the UK and the currency rates were based on indicative quotes. And we had regulators in the United Kingdom saying to us as their advisors, do we have a problem in precious metals? Do we have the same problem in precious metals? I said, no, precious metals have the solution, because precious metals fixes that existed at the time were based on actual transactions. The LIBOR lease rates and the currency rates were based on what banks think that they might charge should somebody actually want this. And I said, if the fix for LIBOR and currencies is to have a fix like you have with precious metals. They didn't go that way. The FSA kicked the can down the road because it was being replaced by the FCA. The FCA came in and said, hey, you got to do something about this. These are not representative forward rates, and they're not representative lease rates. The banks got together. They were not going to share their rates with each other. So rather than try to fix unrepresentative rates, forward and lease rates, they stopped publishing them. And that led to this period where promoters would actually say, oh my God, gold's in a backwardation in London. And we would have mining company executives say, Jeff, I hear that gold is in a backwardation in London. This guy in Toronto who had to leave his company because of issues that he had with misrepresenting the world is saying that gold's in a backwardation in London. We'd say, no, it's not. They say, do you have any data that proves that? I say, no, you don't, because no one publishes forward rates, because as with lease rates, the forward rate kind of depends on who you are and who you're trading with. And it varies from bank to bank. It varies from department to department within a bank. So it's not really there. If you want to know if there's a forward contango, ask for a quote from your bank or banks. And then you'll find out what the contango is and the lease rate really is. Because There is no such thing as the lease rate. It's your lease rate today, and it's your forward price today. All of this is very important to understand when you start hearing people say, oh my God, silver's at a 6% silver lease rate. The silver lease rate is at 6%. Which silver lease rate is that? Is that a 1 month or a 6 month or a 12-month lease rate? Yeah. And is it for a jeweler or electronics manufacturer or a smelter? Who is it? What is that lease rate? And the answer is depends. So silver prices have spiked 5 or 6 times this year, briefly up until the current spike. And that has represented friction in the market that's led to short-term imbalances between supply and demand conditions in different geographic markets. Most notable, people have been focusing on the supply and demand differences between London and northeastern United States. But the reality is that there have been big shifts among different markets, from London to India, from London to China, from London to the United States, from the United States to China. There have been a lot of shifts, and that's led to spikes in the silver price, and it's led to spikes in the silver lease rates that are available to various market participants. Those spikes have been short-lived up until now, and then they come back off. They reflect the fact that the market fundamentals are changing, with higher demand for gold and silver in North America than in Europe, leading some suppliers to move metal to New York from London. This had to do with the demand trends and weaker demand in Europe, stronger demand in the United States. Once the arbitrage widened, other traders came in, as did short-term investors. And then the tariff fears came later and were added to what was already a trend that was well established in the market. Doesn't stop promoters from pushing the narrative that there's an imminent silver shortage on a global basis that will cause the price to rise sharply. Now, it doesn't protect investors from marketing hype. So it's very important to understand. We've seen for a couple years investor liquidation from disenchanted investors who had bought in 2011, 2012, or in 2021. That's diminishing, and that's a very key factor, because what we saw in 1978, 79, and what we saw in the late 90s, early aughties was the first thing you saw was a reduction in the resale by disenchanted investors of silver. Once they cut back on the amount of silver that they were selling, the price started rising. New investors saw a rising silver price and entered the market. That's the dynamics to follow. So that's what I've got to say about lease rates. I hope that I was able to explain a kind of a strange part of the market. Now, is a reality slaps conspiracy theories. Banks continue to have an economic incentive for higher metal prices. They do not have an incentive to suppress metal prices. Banks make more money lending metal out when the price is higher. And International Financial Review was quoting Coalition Greenwich, which did some looking at the commodities and precious metals profitability and earnings of major bullion banks. And last week posted an article, banks' precious metals trading operations are on track for their best year in more than a decade, following frenzied rush from investors to buy gold and the chaotic role of U.S. politics. Right? Precious metals trading revenues at the top 12 investment banks increased more than 60% in the first half of this year compared to last year. The last time we saw this was about a decade ago, and it was when that guy in Canada was financing people to say, let's bankrupt JP Morgan by buying silver and driving the price higher. Because, these guys are all short silver. And what they did was they gave JP Morgan and other bullion banks record profits in their commodities operations. Those record profits, these are near record profits now. The record profits occurred, I think it was probably around 2010, 2012, when that let's bankrupt JP Morgan by buying silver scam. That was it was. It was a scam because it also related to a bunch of bogus information that about how so and so went to Scotiabank to look at his gold and there was no gold in the vault. Another bogus thing promoted for and paid for by that guy. Now, it was 2008, 2009, 2010, 2011, 2012 that scam happened. That's when you saw record profits on the part of bullion banks. When this one guy said, hey, let me use other people's money to drive up the silver price. And I'll say that we're going to do it to bankrupt JP Morgan, knowing full well he knew that this would not bankrupt JP Morgan. They had record profits in their precious metals trading, thanks to that scam. And thanks to the higher prices in metals, now they are at near record levels, up 60% from last year. You are not going to bankrupt a bullion bank by driving gold and silver prices higher. You are going to give them record profits. Oops. I'm going to be traveling a bit, and we may not have a video on Tuesday of next week, the 7th of October. I'll record a video on Thursday for Friday, because I'm off Friday. And then I may be able to record a video Monday or Tuesday, but I may miss it. And I'll be back a week from this Friday. And for our clients, we will have our third quarter question and answer online open forum. We're going to have it on the 13th of October. Missing the third quarter by a couple weeks. I apologize for that, but travel and market conditions have been pretty hectic the last couple months, and we sort of let this slip. If you are a client, you may register for this. If you're not a client, including retail investors, program clients, if you want to participate, become a client. Contact CPM, info@cpmgroup.com, and say, what can I do to become a client in order to participate in this question and answer period? Online, live, you can send in questions beforehand. We usually get like 6 hours worth of questions, and then we have 1 or 2 hours of an open forum. Or you can ask questions during the event. And that'll be October 13th at 11 o'clock Eastern Time. We have EST, Eastern Standard Time. I'm not sure if we'll still be on Standard Time or Daylight Savings in the middle of October because they keep changing the effective change dates. You can go to our website. You can buy our yearbooks. That may or may not make you a client of CPM Groups. Probably makes you a client. So you could buy a gold yearbook or a silver yearbook or a platinum yearbook for $160 each, and then sign up for that. And you can write to us at info@cpmgroup.com and ask us how we can help you be a smarter investor in precious metals and commodities. That's all I have for now. Take care of yourself. Take care of people around you. Watch out for what's going on in the world and try to do something to make the world a little bit better place to live. Take care.